One of the biggest mistakes that people make in business is assuming that corporations are a single entity with one single objective: to maximize returns for their shareholders. The reality is clearly a lot different. Modern corporations are largely run by people who just want to keep their job, management who want their year-end bonuses, overseen by directors with no real connection to the business, representing shareholders who don't even know what individual companies they are investing in, regulated by people who really want to look the other way. None of this is new stuff by itself. But the size, scope, and influence of the financial industry is taking advantage of it to push for business operations that are bad for customers, bad for workers, and ironically, even bad for shareholders. In the process of doing that, private equity and its associated businesses have made some enormous fortunes. But now even those are under threat as people are starting to realize that moving numbers around doesn't actually create any long-term value. And when the money has to come from somewhere, it's probably coming from them.
Toys R Us was the most successful toy company in world history. They were acquired by private equity.
So you have a zero debt mentality. You're going to need to get comfortable with debt.
Those who run these firms have amassed personal fortunes in the billions of dollars.
How do you expect them to sit in an office for 18 hours a day, maximizing shareholder value?
So you buy it for a couple $1 million. The first thing you do is you go and you borrow as much money as humanly possible.
Private equity funds where the returns are really not calculated.
Private equity has become the boogeyman of finance, just like hedge funds were in the 2010s, and sometimes for a good reason. Average people have been told to hate them. Insufferable Wharton grads want to intern with them, and the industry is making more billionaires than oil, real estate, and even technology. The question is, are they creating value or just extracting it? These alternative investments used to be exactly that, alternatives. But the private equity market has changed in just the last 15 years from a small niche that was popular with a select few families to one of the biggest asset holders in the world. Because private equity is private, it can be hard to accurately estimate just how much capital is controlled by these firms. But a report published by the management consulting firm McKinsey & Company estimated that it was over $13 trillion as of June of last year. Given general market conditions and fundraising, it's likely to be even higher now. Now, there is nothing actually that special about private equity. It really just means any investment made into a business or security that is not listed on public markets. So if you invest $1,000 in your brother's farmer's market stall, you are technically a private equity investor. So, make sure to slap it on the LinkedIn profile. So the reason that private equity got so big so quickly has nothing to do with it being an amazing investment or anything silly like that. It's purely the result of a financial system that has become too concentrated. The American economy, finance, and business activity are all much bigger than they were in the 1990s, but the number of publicly listed companies has actually gone way down since then. In fact, it's almost halved in the same time the economy has tripled in size. Now, one big reason for there being less publicly listed companies is simply because bigger companies have been acquiring smaller companies at record rates, making for a more concentrated business environment with fewer companies overall, which is, the whole point of this video. But we will actually get to the consolidation later. There are also fewer companies IPOing in the first place, because there really is no need to anymore. Companies list themselves on stock exchanges to raise money from the public, hence why it's called an initial public offering. But the general public just doesn't have that much money anymore. The wealthiest 10% of Americans now own 93% of all publicly listed stocks. The vast majority of capital flowing into public stock markets comes from people or institutions that are rich enough to invest in private equity, so the regulatory and reporting burden of being a public company just simply isn't worth it to get access to 90% of people who all collectively own just 7% of the market. That 93% of stock ownership is largely held through retirement accounts, which are handled by funds which can invest into private equity as well. So for most companies, it just doesn't make sense to go public anymore. Now, alright, so what? People have slightly fewer options to ape their life savings into on Robinhood. Well, apart from that, this trend, which has only really been going on for 15 years at this point, is really causing a lot of problems and costing you a lot more than you realize. The first issue that doesn't get nearly enough attention is how they have created micro-monopolies. When you think of monopolies, you are probably going to think of giant companies that own entire markets everywhere across the world. Like, YouTube. But a much more common type of monopoly has started to become a bigger problem. These are small, local monopolies. One of the hottest new private equity investments has become youth sports leagues. Little League is a great investment because firms can buy up all the sports in a local area and create a monopoly on competitive team activities. And nobody wants to be the parent that denies their child the opportunity to go and touch grass with their friends. According to a report by the Aspen Institute, these local leagues are collectively a $30 billion industry, and they are becoming more expensive as they are consolidated by private equity firms. Now, this is just one particularly scummy example, but creating local monopolies is just a good business strategy. It's not technically legal, but the Federal Trade Commission just doesn't have the manpower to identify and enforce these thousands of local issues when they don't even really have the resources to go after the most obvious monopolies. These subtle consolidations have changed how and where we spend our money, but it has had a much more serious impact on how we earn our money. So it's time to learn how money works to find out if it's possible to reverse the concentration of everything. This week's video is sponsored by Delete Me. Ever get that unsettling feeling that the internet just knows too much about you? It's not your imagination, it's data brokers. These companies collect and sell your personal details, your name, address, phone number, even info about your family without your permission. And once that data is out there, it keeps circulating. That's why I started using Delete Me. It's a privacy service that tracks down where your data is being sold online and works to remove it. They scan hundreds of data broker sites, file removal requests on your behalf, and keep monitoring to make sure your information doesn't pop back up. I've been using Delete Me myself, and honestly, it's been eye-opening to see how much of my personal info they've already scrubbed away. My first privacy report listed dozens of sites holding my data, and watching that list shrink felt like taking back a little control. Sure, I'm still online, that's unavoidable, but now I'm a lot harder to track. If you're thinking about your own digital footprint or protecting your family's, Delete Me's family plan can keep your loved one's data under wraps too. It's something I'd wish I'd gotten started on much earlier. Get 20% off Delete Me consumer plans when you go to joindeleteme.com/HMWU and use promo code HMWU at checkout. That's joindeleteme.com/HMWU, code HMWU. Another major problem with a lot of businesses being owned by a very small group of investment firms is that it makes it really hard to see what is actually happening in our own economy. Public companies have to release regular financial statements, and their market value is updated every microsecond as their stock is traded. As more of the market is held by a smaller group of investment firms, it gets harder to tell how these businesses are performing and how they are being run. John Coates, a professor of law and economics at Harvard, recently released a book called The Problem of 12, When a Few Financial Institutions Control Everything, which addressed exactly this problem. Specifically, he mentions that pension funds have found private equity very attractive, and since most pension funds are investing on behalf of regular people, it can be very difficult for those people to see how their money is being used since there are two financial institutions between them and the business they are actually investing in. Coates also speaks about the concentration of capital in index funds like Vanguard, BlackRock, and State Street. He doesn't highlight the usual criticism like Larry Fink being a lizard man that secretly controls the global economy, but he does raise the issue that the way these financial products invest money makes normal price discovery much harder and also incentivizes getting more concentrated. Something like Vanguard's VOO ETF just mindlessly takes investor money and puts it directly into the weighted average of the 505 stocks that make up the S&P 500. And yes, there are actually 505 stocks in the S&P 500 because some companies list Class A and B shares. Finance bros aren't very good at naming things. This means that a large share of investors are just investing in whatever has the most investors, which has just helped contribute to immense valuations of companies at the top of the market. The amount of investment capital concentrated through these investment managers means that they now have significant influence over company shareholder votes, and new products like ESG or green ETFs can have more influence over board decisions than they really should have. There will be a link in the description below to that book if you are interested in reading the whole thing, though you should know it was written for MBA students at Harvard, so it is a little bit dense. He also gave a half-hour interview just last month available here on YouTube, which is also worth checking out. Another big problem is corporate debt. Most of the biggest private equity firms in the world use what's called a leveraged buyout. This is where they will buy a whole lot of companies, get those companies to take out big loans, and then use the borrowed money to pay themselves back so that they can go and buy even more companies. This normally involves a lot of cost cutting in the business so they can make their repayments. But on a wider scale, it's contributed to the record levels of corporate debt that we have in America today, which as a percent of GDP was only higher during the first wave of PPP loans, and just after the global financial crisis. Businesses always want to get more concentrated. It's the natural order that big businesses will acquire little businesses or put them out of work. The rise of private equity, the proliferation of passive index funds, low interest rates, and the flaccid approach of regulators has only made this natural process much faster. But this still isn't the worst part. Corporate concentration has made finding competitive job opportunities extremely difficult. especially for people in smaller communities that have had local businesses quietly rolled up by large investment funds. The best way to get a higher salary as a worker is to switch jobs for better opportunities. But if you are a plumber and all of the plumbing businesses in the local area are owned by the same holding company, you aren't going to be able to negotiate like you would with competing businesses. Now, if you think you could get around this problem by starting a business of your own, well, actually it gets even worse. In an article published by the Washington Post, Lillian Salerno, a healthcare entrepreneur, spoke about her difficulty in bringing a new, safer medical syringe to the market because businesses up and down the supply chain had become highly consolidated, so they didn't want to work with a potential competitor even if her product would have been better for patients. This is technically anti-competitive practice, but again, regulators are understaffed and underfunded. It's even worse in highly scalable industries like technology. The most important thing that early-stage investors now look for in startup companies is an exit strategy, which is just business speak for who is going to buy this company if it's successful. Those buyers are either a few of the industry top players or a private equity firm. The result of this is that only companies with the highest potential to scale and the best opportunity for acquisition actually get funded, which is why places like Silicon Valley have gone from making technology to solve the world's problems to writing algorithms to keep you watching your phone for an extra 20 seconds a day. A blog post written by Ross Spears, who is ironically the president of a venture capital firm, called this the stagnant pool of American entrepreneurship. If you wanted to start a company tomorrow, you probably wouldn't know where to start, especially if you had to go and raise capital from professional investors. There are programs like Y Combinator that incubate early-stage companies, but access to these programs is highly competitive. 2023 saw a record number of new businesses being created here in America, with 5.5 million new companies being registered within a year. Data hasn't been published for 2024 yet, but most expectations suggest this record could be broken again. At the same time, it seems like every pre-revenue, pre-idea, pre-clue startup that vaguely mentions artificial intelligence is getting billions of dollars thrown at them by cashed-up investors. And yet, there is a problem that you may not have noticed. There just aren't that many companies anymore. In 1996, the market hit an all-time record of 8,090 companies publicly listed on the various stock markets around America. Today, almost 30 years later, despite the economy being 3 times larger and the market handling about 7 times as much capital, there are fewer than half as many companies publicly available to buy shares in. There are a lot of theories about what is going on here, from private equity making Wall Street irrelevant, corporate consolidation, to the dwindling of savings of average investors. But there are some even bigger issues at play here. So, where the f did all the companies go?
File, the largest toy store chain in the U.S., Toys R Us, has filed for bankruptcy protection.
Involving Purdue Pharma, the company that made billions selling the prescription painkiller.
Time is almost up for Bed Bath & Beyond, filing for bankruptcy protection and liquidating hundreds of stores.
Some tech companies go public a bit too early. We still see tons of opportunity to change and grow the business quite a lot.
These 7 companies have risen and risen until they've become basically all of the stock market.
At the time this video was released, 34.1% of market capitalization of the S&P 500 was comprised of just 7 companies: Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, and Tesla. If you throw in Berkshire, Broadcom, and Walmart, then that is over half of the entire market in just 10 companies. According to data from Standard & Poor's, at the end of 2015, the top 10 companies only accounted for 16.2% of the market. So in less than a decade, the market concentration within the biggest companies has tripled. Even if there were more companies that the public could invest in, they would matter a whole lot less. This trend is bad for investors, bad for workers, bad for consumers, and strangely, it's actually even bad for the companies themselves. But I am getting ahead of myself. First, we need to know why this is happening. One of the big changes that most analysts are pointing to is the growing role of private equity. We have discussed the details of exactly what private equity is in a few videos, but if you are new here, all you need to know is that it's a firm that invests in companies or other assets that are not listed on public exchanges like the NASDAQ or New York Stock Exchange. According to the investment data firm Preqin, the amount of money that private equity firms are now managing in America alone is up 1,200% since the year 2000. So as this has grown, market share has been taken away from public exchanges. For a lot of companies, it's just not worth it to meet the compliance requirements of public listings because then early investors and management have to listen to thousands of stockholders instead of just 1 or 2 big private equity firms. Average investors also don't have that much money, and the average person owns most of their shares through managed retirement accounts anyway. Those retirement funds also invest in private equity firms, so going public doesn't really offer anything that can't be achieved by just selling to a private equity firm unless the company is absolutely massive. Even when private equity firms want to take profit on their investments, there is a growing trend of them just selling their assets to other, even bigger private equity firms. According to records from Apollo, one of the biggest private equity firms in the world, the number of companies financed by private equity increased by over 9,000 since the turn of the millennium. If these companies had to raise money the old-fashioned way through an IPO, then the number of public companies would be much more in line with the historical trend. So mystery solved, right? Wrong. There is one more story than just private equity ruining everything. Again, just having the same number of companies as there were 30 years ago wouldn't account for the fact that the economy is much larger overall. If the relationship between businesses and business activity held, there should be something like 25,000 public companies, but there are actually less than 4,000. Not only are companies getting more concentrated, but their ownership is getting more concentrated as well. The largest shareholders in almost every major company listed in America and most of the rest of the world today is some combination of BlackRock, State Street, and Vanguard. Now, you have probably seen the endless thumbnails about these companies being evil empires plotting world domination. And honestly, that's probably not true. The reality is that they manage assets on behalf of millions of individual investors. They don't actually own that themselves. The index investment products they offer are also really convenient for most investors who want diversified exposure to the market but are unable to buy and balance hundreds of shares individually because that would take an inordinate amount of time and money. But even though this reality is a little bit less exciting than an evil empire operating from the shadows, it doesn't mean that its growing popularity is any less damaging to your actual financial situation. And to see why, we are going to have to roleplay as Wendover Productions for a second. According to public 13G filings, the top shareholder of Delta, Southwest, United, and American Airlines is the Vanguard Group, which owns millions of shares in each company primarily on behalf of their clients through its index products. Collectively, American, Delta, Southwest, and United control more than 70% of the market for air travel within America, according to the commercial aviation data firm AOG. Individually, the best way for these companies to grow their business would be to take market share from one of the other three by offering lower prices, better service, or more convenient routes. This is the basis of good, healthy competition. And in the battle days, when shareholders would largely own one company they believed in, this is how it would work. But when their largest shareholders also own an equal stake in every other business in the market, they are a little bit less keen on crushing their opposition. If Delta pushed hard against United on all of their routes, then they might take market share from them. But for their shareholders, all they have done is cut into the profit margins to win a war against themselves. Instead, the growing pool of shareholders that own stakes in all of these companies equally are going to be financially better off if these companies grow their margins by extracting more from their customers through cost-cutting service, more fees, and confusing bookings. If you can believe that that would ever happen. Now, even this by itself isn't the whole story, because, spoiler alert, this little game isn't even good for the shareholders either. Now, hot take alert, but if they are all well regulated and they are not in vital industries, sometimes monopolies can be good for consumers, at least for a little while. Netflix once had a near monopoly on content streaming, and for a few years it was really good. The price was reasonable, and in return you could get access to an extensive library of on-demand content without the challenges and risks that came with sailing the high seas. But seeing the opportunity, companies like Disney, Apple, Paramount, NBC Universal, Amazon, and Warner Brothers all introduced their own offerings to the market and started locking their own content with their own subscriptions. Today, to get access to a comprehensive library of content, you would need about 5 or 6 different subscriptions, easily costing more than the cable this was all supposed to replace. Even the studios arguably did better under the Netflix arrangement, because they could license their content for additional revenue instead of losing billions of dollars every year trying to take market share. Now, this is actually nothing new. As new technologies emerge, lots of businesses try to get into the market and naturally only a few survive. Even the very first international corporations, the Dutch, British, and French East India companies, were effectively just state-sanctioned monopolies because that was the only way they would work. The difference now is that instead of raising money and starting a new business from scratch to take advantage of a new marketable technology, existing businesses just use their own cash to do it in-house. Netflix is the only major player in the streaming market that wasn't already a film studio or major technology company before getting into streaming, and outside of digital media, the lesson is the same. Big is beautiful. A company like Amazon can offer same-day delivery and global cloud computing services because of its scale. Individual brick-and-mortar retailers could be content with operating out of a few select locations, but to compete directly with Amazon would require an investment of hundreds of billions of dollars into an immense network of warehouses and distribution centers. It's easier for most businesses to just give up and sell through Amazon instead. Legacy brands like Toys R Us or Bed Bath & Beyond just can't compete on price or convenience with their smaller scale and higher overhead. Social media, like the brands under Meta, only have value if everybody is using the same service, so users naturally gravitate towards the largest providers in any particular niche. If you want to shout about how hard it was back in your day under Minion memes, you go to Facebook. If you want to shout about how hard it is under the current day under Bernie memes, you go to Reddit. And if you want to shout about how hard it is to synergistically integrate the joint development interregional self-layoff project, you go to LinkedIn. Because that's where you will find fellow boomers, fellow comrades, and fellow corpo bots respectively. Now, I know you know that antitrust regulation is severely lacking here in America, and most of the rest of the world. But even if we are actually good at playing Monopoly Whack-A-Mole, they will naturally keep popping up. Companies themselves are less resistant to being acquired because a lot of their investors are the same people on both sides. And a single entity that isn't regulated should make better returns than two entities that have to, at least pretend to, compete. Businesses getting bigger is the natural process. Big businesses have more money to invest into more growth and more opportunities, and if these companies can't create something from scratch, they will just buy it from someone who can. So far, you have seen how the shifting role of private equity in broad market asset managers has accelerated this, but there is another group that's emerged that stops a lot of companies from even existing in the first place. Ironically, venture capital is a niche of private equity that focuses on funding hopeful startups rather than large existing businesses. In theory, lots of venture capital activity should encourage lots of new business development, but the industry has realized that's not the best way to maximize returns. The best way to make money is to instead scale a business really quickly in the hopes that the big tech companies will just acquire it. A paper published by the Journal of Information, Economics and Policy found that this process systematically stifled genuine innovation, because businesses were funded to be sold, not to actually provide value to the market. The problem is if these companies try to start a service that competes with one of these companies' existing services, venture capitalists don't want to touch it, because it becomes far too risky. The existing company with huge cash reserves can compete with the fledgling startup until they have run out of cash and then go back to business as usual. This creates what the economists affectionately branded kill zones, where startups find it really hard to find investors once they threaten the existing big businesses. The most laughably ironic thing about all of this is that yes, businesses with more market power are bad for consumers, who they have more price control over, and even worse for employees who may only have one or two companies where they can get a job with their skills. But the great business extinction hasn't even been good for investors. As private equity, venture capital, and asset management firms have become larger players between investors and the companies they are investing in, they have soaked up more money in commissions, fees, consulting dues, and performance incentives. Income from the finance industry used to account for roughly 3.5% of GDP until the early 70s, but today it accounts for over 10% according to data from the Bureau of Economic Analysis. That's 10% of the country's entire economy dedicated to paying bankers and financiers to move assets around between one another. The assets held by these institutions has also grown from less than 50% of GDP in 1980 to over 180% today. This means that a lot of these firms aren't too big to fail. They are just too big. Regulation should be here to deal with these misaligned incentives, but the last time the FTC ever broke up a company was right here in 1984 with AT&T. Since then, the only punishment for anti-competitive use of market power has been fines, and well, you know the thing about fines. To kick off the new year, Mark Zuckerberg, a man who is definitely not having a midlife crisis, announced that Dana White, the president and CEO of the Ultimate Fighting Championship, had been elected to Meta's board of directors. The decision was met with some mixed reactions from company employees and stakeholders. But what most people don't realize is that this decision is really not that unusual. The board of the embattled Boeing Corporation recently appointed Mortimer J. Buckley, the former CEO of the Vanguard Group, who also serves on the board of Pfizer, alongside James Quincy, the CEO of the Coca-Cola Company, who also serves on its board alongside Bella Bahara, the chief content officer of Netflix, who serves under a board which includes Anne Sweeney, the former chairman of the FX Networks, who worked under Tony Vinciquerra, the chairman of the Fox Networks Group, who currently serves on the board of Qualcomm, a company formerly managed by Steven Mollenkopf, who currently sits on the board of directors of Boeing. It's a great big club, and you ain't in it. But what the f do these people actually do?
On Monday, Meta founder and CEO Mark Zuckerberg announced that UFC president Dana White will be joining his company's board of directors.
January, he tapped Dana White for a Meta board spot and is now ending this fact-checking.
Metro Health Board of Trustees terminated Dr. Boutros yesterday, effective immediately.
Before you can understand what modern boards of directors actually do, you should first understand what they are supposed to do. If you get appointed to the board of directors of a major company, it is not a full-time job. If everything is running smoothly, you might only need to show up for a monthly or quarterly board meeting where you will receive a presentation on how the company is going from the management team. Normally, this presentation is given by the CEO, but they can also bring in other executives if they are talking to the board about a particular area of interest in the company. If, as a random example, the company wanted to invest $46 billion into an augmented reality social platform, the CEO might bring in their technology officer and the chief financial officer to talk about the viability of that project. The role of the board is to provide advice, or in extreme cases, veto the ideas of company leadership, which hopefully acts in the interest of the shareholders who they represent. The CEO doesn't need to listen to them, but the board has the power to fire them, so if they want to keep their high-paying job, they normally try their very best to keep them happy. The board also oversees executive compensation. CEOs and shareholders are not always necessarily aligned on objectives. If you are a CEO, your number one priority is to make as much money as you can while you have your job, by A, not getting fired, and B, securing the biggest pay packet possible. This can mean that CEOs often prioritize short-term wins over long-term business stability, because it doesn't matter if the share price is great in 10 years' time if they get fired for a year of poor stock performance. The board of directors is supposed to add a level of human intelligence and long-term thinking to business management and call out CEOs that are just gaming the system to enrich themselves. Now, the other thing is, if you are a company director, you don't technically need to do any of this. You don't even really need to show up to the once-a-quarter meetings. There is nobody who sits above you in the corporate hierarchy, so there is nobody to fire you. To sweeten the deal, compensation for serving on the board of large public companies can be extremely generous. According to company filings, in the fiscal year 2023, the directors of Meta were paid between $397,000 and $4.2 million in equity, cash, and travel reimbursements. This can be especially lucrative if you work your way onto multiple boards like Alex Skorsky or Deborah Reed, who sit on 4 public boards each, including some of the world's most valuable companies. This practice actually used to be much worse up until a few years ago, but more on why that changed a bit later. It's not a bad gig if you can get it. So if you're thinking that showing up to a meeting a few times a year for 6 or 7 figures sounds like a good deal to you, here is how you land a job on a board. The first option is to get nominated to the board before the company goes public. The easiest way to do that is to either start the company yourself and just elect yourself and maybe a family member or two, or to be an early stage investor that insists on getting a board seat as a part of your investment into the business. A lot of early stage venture capital investors really want a board seat or two because it gives them a few special privileges. Pay is not one of them. Normally, board members for small companies, especially cash-strapped startups, don't receive any compensation at all. But that doesn't really matter, because big investors getting paid to sit on the board would really just be paying themselves their own money back anyway, which doesn't really make much sense. But there are some real benefits to sitting on the board. As a member of the board, they will be privy to company information that isn't shared with regular investors, and more importantly, they can fire the CEO if they feel like they are not doing a good job. If you ever find yourself raising venture capital for a new startup, you should know that you can be fired from your own company if you give away enough board seats by selling away too much ownership in your business. You can write rules into the company bylaws to prevent this, but then you might find it much harder to raise capital from investors who want to keep the big red button option. Of course, VC firms really don't want to do this, because if you still own a majority of the company, you can make life difficult for them to get a return on their investment in other ways. But having checks and balances on power is always a good thing, even in tiny little startups. So unless you already have millions of dollars to invest, or you're really interested in some new technology or nonprofit initiative, you are probably going to prefer being a board member of a public company instead. Once a company goes public, there are a lot of rules about how a board is elected, and shareholders must be able to vote on representation. So in theory, a company's board of directors should act like elected representatives who always act in the best interest of their constituents, right? According to company filings compiled by Fortune magazine, the average age of an S&P 500 board member is 63.1 years old. That's the average. So for every Mark Zuckerberg who is only 40 years old, there's an 86-year-old holding their board seat like it's a Senate seat. Anyway, The real job of most board members in modern companies is to be a contact network between regulators, politicians, and other business leaders. The reason that board directors tend to be so old is because these roles are often just given to people who have already had long and prestigious careers in business or government and have built up a long list of friends in high places. Dana White may genuinely be a very talented businessman, and there is actually a surprising amount of overlap between the mindless hand-to-hand combat that takes place on Facebook and the UFC. But the real reason he was elected to the board is not so subtly because he is close friends with the newly elected president. Trump's administration has made it very well known that they are going to be more business-friendly and slow down all the actions of the SEC and the FTC.
Crypto, they're going to let it grow. We're going to let it grow. On day one, I will fire Gary Gensler and appoint a new SEC chairman.
But that's all with the exception of just two businesses, Alphabet and Meta. Hating the biggest, most invasive tech companies might very well be the one thing that unites America. Getting Dana White on the board means that Meta has a friendly connection to the White House. Now, the same could have been achieved with a much less high-profile board nomination. Dana is not the only person with friendly ties to the incoming administration. But outside of Elon Musk, who has his own social media company, he's probably the most famous person that could reasonably fill this role. The reason that you are hearing about this appointment is because the company wants you to hear about it. It's a marketing play to signal that the company is not some soy cap-sipping California hive mind. Modern boards really act as a contact network and marketing display to other institutions and government agencies. Some of the most popular jobs for retired senior government personnel is to sit on the board of directors. That is because it's a pretty low-intensity retirement gig that pays them very well, and their lifetime of building contacts through their career is a pretty big asset to their company. Another perk for certain companies is it gives them a level of credibility in their business functions. Military supply companies, including Boeing from earlier, normally have one or two retired high-ranking military personnel on their board to signal that they listen directly to the armed forces. The final reason that modern boards have become so cozy is something you're not really allowed to say out loud. If companies have a long history of electing former government officials to their board, then current government officials might try to get a little bit more cozy with them to secure a nice post-retirement gig for themselves. So yeah, if you want to get elected to the board of directors, you really need to start filling out a contact list of anybody and everybody that could make or break a company. If you want to go the private route, you should work in audit or a big consulting firm, or work in a government authority like the SEC or the FTC. And don't be like Lena Khan, and actually do your job a little bit too well. The board is supposed to represent the best interests of shareholders, but it's becoming harder and harder to determine what that actually means. The largest shareholders in most public companies are almost always Vanguard, BlackRock, and State Street, large asset managers that build index funds on behalf of other investors or institutions. It's really hard to ask about the role of those companies without going down the lizard man rabbit hole claiming they secretly control the world. The reality is a little bit less entertaining. But the immense scale that these companies have grown to means that if you want to be elected to the board of directors, you really only need their vote rather than the vote of the other shareholders. Now, these companies don't actually own the shares themselves. They own them in a trust on behalf of the actual investors who buy into their index funds. Some of these funds have even started introducing tools to allow their investors to vote on how the fund itself will vote. But the kind of set-and-forget investors that buy these index funds normally aren't that interested in submitting proxy votes for the hundreds of companies in these investment products, so the asset managers themselves have a lot of influence over shaping boardrooms, and by extension, the companies they oversee. The reason that there aren't as many directors that sit on dozens of boards at a time anymore is because both BlackRock and Vanguard introduced policies where they would vote against any director that already held 4 or more board seats in public companies. In a clear demonstration of just how much power these passive guidelines can have, there are no longer any S&P 500 directors that hold more than 4 board seats, although there are a lot that hold exactly 4. So, make of that what you will. Now, you might think this actually seems like a positive effect. It's limiting just how consolidated the Global Directors Club can get, but the problem is that you may not necessarily agree with the other ways that they use their massive votes. The voting guidelines for these companies are available online for anybody to read, but of course, most people never will. In these documents, there is heavy emphasis on diversity, inclusivity, representation, and environmental efforts in boardroom votes. Again, these might very well be great initiatives, but there it creates 2 problems. One is the internal regulatory efforts that are normally highly ineffective, and are often just used as a way for companies to claim that they can keep themselves accountable. No need for government authorities to perform real checks. The second problem it creates is that it's become really easy for well-connected corporate interests to stack boards with who they want based on ticking boxes rather than electing someone genuinely looking out for shareholders. The consequences of boards that aren't as critical as they could be are things like record CEO pay, even if paying someone hundreds of millions of dollars isn't really in the best interest of investors. So if this job still sounds like a sweet gig for you, step 1 is to gather as many high-profile connections as you can. Step 2 is to get cozy with company leadership. Step 3 is to tick as many boxes on the Vanguard voting guidelines as possible, and step 4 is to still care enough. By the time you get this far, you have probably had a very long and successful career. And unless you are working in the government for most of that time, a few $100,000 a year isn't going to change much for you. So the real reason you would want a board seat is for the power and prestige, without the trade-offs of hanging out with the strange people that inhabit Congress. The stagnation of corporate boardrooms has also led to a lot of companies just following the latest investment trend, even if it makes absolutely no business sense. Making profits doesn't matter if the whole company can just be sold to a bigger company that wants it out of the way. Business decisions made in the interest of maximizing shareholder value have caused mass layoffs, environmental catastrophes, an endless list of corporate frauds, and record inequality in the workplace. The very same CEO who made millions of dollars by being the first champion of maximizing shareholder value in the 60s called it the dumbest idea in the world, and something that could rot capitalism to its core. But worst of all, maximizing shareholder value isn't even good for the shareholders.
Indeed, managers, the CEO, have a fiduciary duty to their shareholders to be concerned only with the bottom line. We think this is wrong, a serious mistake.
But continue to create the capacity to be able to reward our shareholders as we have done in 2023 and as we hope to continue to do in 2024.
Roundtable today sparking a debate about the purpose of a corporation and why maximizing shareholder returns is no longer the main goal.
If you hate your job, here is a history lesson for you that might make it start to make sense. In 1916, the Ford Motor Company had revolutionized the automobile industry with the Ford Model T. Henry Ford, the founder and majority stockholder of the company, wanted to use the surplus cash they had accumulated to build additional plants and hire even more workers to build even more cars. Ford had also famously and controversially raised factory worker wages significantly and offered benefits like the 40-hour work week. In press interviews, Ford spoke about his plans for the company. "My ambition is to employ still more men, to spread the benefits of the industrial system to the greatest possible number, to help them build up their lives and their homes. To do this, we are putting the greatest share of our profits back into the business." This angered minority shareholders in the company that just wanted him to lower wages again, raise the price of the Model T, and keep paying them a regular dividend. Since Ford was the majority shareholder in the company, though, their options were limited. So they took him to court. But the court sided with the minority shareholders. Ford was forced to consider the best interests of shareholders above his other business ambitions. This was the case that set the precedent for shareholder primacy in America, meaning the board of directors and executives in a company must always try to maximize shareholder value to the best of their ability. Some have mistaken this ruling to mean that CEOs and the boards that appoint them have a legal mandate to maximize shareholder value, but the reality is that this simply isn't true. The case was awarded in favor of the minority shareholders, but it upheld the business judgment rule, which means that executives can do what they believe is in the best interest of the company, even if it doesn't make the number on a stock chart go up. Ford himself wasn't paying his workers more and making new jobs because he wanted to be nice. He was a ruthless businessman who wanted to control a larger share of the growing automobile market. By paying his workers better and offering them higher wages, he was just denying his competitors a workforce. And by pricing his Model Ts just above cost, he made it almost impossible for any other manufacturer to sell a profitable budget automobile. The biggest irony of all of this is the minority shareholders that took Ford to court were John and Horace Dodge. They owned about 10% of the company and used their special dividends to fund growth of their own company, Dodge, a car maker that would eventually become one of Ford Motor's biggest rivals. So this court ruling was bad for the company's leaders, bad for workers, bad for the country, and bad for the shareholders in Ford who sacrificed market dominance for a quick payday. But there are 3 reasons why people still believe in maximizing shareholder value, and 3 reasons why companies that operate this way are almost guaranteed to fail. Corporate America didn't always have the dangerous obsession with shareholder value that it does today. And even after the landmark Dodge versus Ford case in 1919, companies were slow to change. Between the mid-1960s and 1970s, American stock markets traded mostly sideways. corporate CEOs still had a duty to do what was best for the company, but they were paid a normal salary and a small bonus just like every other normal employee. According to the Economic Policy Institute and the National Bureau of Labor Statistics, CEOs at this time made around 20 times as much as the average employee of their company. So they were still rich, but not so rich that they could retire after one good year. Their motivation was primarily to keep the company running safely so they could maintain their well-paid jobs for as long as possible. By the 1990s, a small group of financiers got the idea that in order to grow to get better returns from their companies, they should align the interests of their CEO with their own interests of getting the stock price as high as possible. They did this by paying the CEOs a smaller cash salary, but added stock options that directly tied CEO bonuses to stock performance. In the 1990s, CEO compensation went from 60 times average worker pay to 380 times average worker pay. My friend Patrick Boyle did a great video on how this small change in corporate norms eventually led to people like Elon Musk demanding $50 billion in compensation for 1 year's work. Now that there was so much money to be made, CEOs and other senior executives were happy to go along with the lie that it was their legal duty to maximize shareholder value, even if it would destroy their companies in the long term. The first strategy they used was picking up pennies in front of a steamroller. It won't surprise you that some of the biggest companies in the world have taken dumb risks. We have seen some of the biggest corporate bankruptcies in history happen in just the past 24 months, and it's becoming more common. If you are a CEO with a multi-million-dollar bonus package on the table, you are going to do everything in your power to tick the boxes you need for the board to grant you that bonus. A top priority for you as the CEO is going to be to increase your company stock price, pay a big dividend, or both. Most bonuses are awarded year to year, and according to Fortune magazine, the average tenure of a Fortune 500 CEO is now only 7 years. For you, big projects that could pay off over decades are effectively useless, unless their announcement could drive up your stock price. But even that's unlikely. Investors rarely care about long-term business strategies because they so rarely come true anyway. Your best strategy is to control bad publicity and focus on next quarter's financials. An easy place to cut expenses is in areas like security, auditing, risk management, safety controls, long-term development, and training. If you cut these enough, you might even increase revenue at the same time, because sales staff in revenue centers can operate more freely without pesky compliance departments making sure things aren't being done illegally. Silicon Valley Bank, one of the largest bank failures in American history, had a risk management department that regulators described as terrible. That's about the harshest thing that financial regulators say about anything. Lehman Brothers went bankrupt because it couldn't say no to the revenue it was making from subprime mortgage bonds. Boeing's repeated string of airline failures has been blamed on a push to get new planes into the air by cutting down on safety controls and testing. HSBC, one of the biggest banks in the world, made billions of dollars in revenue by providing financial services to international criminals. People have lost their jobs, lost savings, and lost their lives in these scandals. But worse than all of that, the shareholders lost billions of dollars from scandals like these and others that are too numerous to list. But the CEOs that ultimately oversaw the companies making these terrible risk trade-offs already made their enormous bonuses, and some of them even got a golden parachute on the way out. Business departments like risk management and cybersecurity have tough jobs. If everything is going well, people question what good they are doing for the business. If things are going badly, people question what good they are doing for the business. You can make a little money by picking up pennies in front of a steamroller, but if something goes wrong, you get smushed all for a few dollars. The short-sighted nature of CEOs mandated to maximize shareholder value is also the second reason it's one of the worst ideas in the history of business. It guarantees that businesses become worse. Jack Welch was the chairman and CEO of General Electric from 1981 to 2001. He worked his way up in the company from an entry-level position, but upon stepping into the top job, he radically reshaped the company in the name of the shareholders. Welch made 72,000 of GE's 400,000 employees redundant. He sold off entire company divisions, and he invested heavily in financial and media arms of the business. GE Capital became the primary focus of an engineering company that made consumer appliances, commercial machinery, and aerospace parts. Welch also pioneered outsourcing and bragged about it on CNBC, a news network he created to focus on business news after GE acquired NBC. His ruthless strategy worked, and during his 20 years as CEO, GE's stock price rose from $6 a share to a high of almost $370 a share a year before being asked to walk away from the company. He did, but not before being awarded an exit package estimated at $417 million. Other CEOs who were now getting paid mainly with stock options saw this maverick CEO talking about his strategies on his own news network, and they figured they couldn't argue with the results. According to data from the Economic Policy Institute, the year that Jack Welch took over as the CEO of General Electric was the last year when increases in worker productivity kept pace with increases in wages. Make of that what you would. Welch's focus on shareholder above every other stakeholder in the business worked well for a long time. But since he was pushed out of the company, the stock price of GE has fallen by roughly 70% from its all-time high, even during a record bull run where the market is up by 400%. GE used to make high-quality products that customers were highly loyal to. GE's outsourcing delivered worse products to the market, leading customers to buy from other brands. GE used to be one of the most attractive companies to work for because they were stable, paid well, and let employees, like Jack Welch himself, work their way up the corporate ladder. GE's CEO proudly boasting about mass layoffs and firing the bottom 10% of staff every year meant it became one of the least desirable companies to work for, so top talent went elsewhere. By sacrificing customers and employees to appease shareholders, they made it worse for them too. Welch himself even said in an interview that maximizing shareholder value was stupid. A high stock price is the result of doing everything else correctly. Why didn't he follow his own advice? Well, because he made too much money by keeping the people that paid him happy. During Welch's tenure as CEO, GE was almost suspiciously good at meeting financial goals. Roger Martin, the dean of the Rotman School of Business at the University of Toronto, said in an interview with Forbes that GE met or beat analyst forecasts in 46 of 48 quarters between December 31st, 1989 and September 30th, 2001, a 96% hit rate. Even more impressive, in 41 of those 46 quarters, GE hit the analyst forecast to the exact penny, 89% perfection. Of course, this wasn't amazing management. It was good old-fashioned creative accounting, a practice that got GE in hot water with the SEC and was part of the reason why Welch was eventually asked to nicely leave the company. Despite his tarnished record, Welch's business practices are still common in a lot of corporate boardrooms across the world. Okay, so you might ask, if encouraging CEOs to pursue short-term gains has shown to be bad for everyone, including the shareholders who appoint the board, who employ the CEO, why are companies still doing this? Well, that's because the third reason why maximizing shareholder value is a terrible idea for everyone. The short term is all that matters. According to data from the largest stock exchanges in America, the average holding period for stocks has been consistently declining for decades. In 1975, investors held onto stocks for an average of 5 years. In 2021, they held onto them for less than 1 year. Electronic brokerages have made buying and selling shares much easier. And people are generally in financial situations that are much less secure where selling shares becomes a way to cover an unexpected expense. That's not how long-term investing should be done, but staying ahead financially these days is hard. The largest dips in shareholder holding periods happened in 2001 and 2008, during down markets and job losses where people were probably selling at a loss on their holdings but needed to cover their expenses one way or another. Long-term capital gains tax laws also encourage people to seek profits from buying and selling year to year rather than a dividend strategy which can be less tax efficient. The result is that if people are holding onto shares for less time, then they also only care about short-term wins. So a CEO that delivers a profitable fourth quarter will be more popular than a CEO who reinvests company earnings into training, R&D, or safety that won't pay off for years. This kind of short-term thinking is not sustainable, but that's another shareholder and CEO's problem. The rapid growth of private equity has been blamed for pretty much every problem in America today, from mass layoffs to unaffordable homes. Some of this hate is totally justified, and some of it is just coming from second-generation Wharton grads who didn't land a summer internship at Blackstone. Whatever your reason is for hating private equity, you will be happy to know that after a meteoric rise, the whole model that this industry was based on is now facing a wild collapse.
And I really do think that when you have a group sitting as a state pension fund,
Warren, all they're doing is lying a little bit to make the money come in.
Yeah, that sums it up.
That's because that borrowed money becomes the responsibility of the company itself,
private equity
not the private
is
equity.
Among the most malevolent sources in American economic life and global economic life.
Private equity is very simply any investment into assets not listed on public markets. There are hundreds of thousands of highly profitable and promising businesses in America and millions around the world that you would never be able to buy using Robinhood and some pocket money. private companies are not listed on public exchanges and don't have the same reporting requirements, so it can be extremely difficult and time-consuming for investors to get a good idea if a business is worth buying and how much it would be worth if it is. This is where private equity firms stepped in as middlemen to offer rich investors access to this untapped market. If you were a billionaire or the manager of a pension fund, their pitch to you was simple. They could give you a higher average investment return than you could get in the boring old stock market. Your returns would be less volatile, and your money would be safer from market crashes. They could do this because they employed a crack team of the best analysts in the world to do all the hard work of finding and buying a private company or alternative assets on your behalf, and extracting as much money as physically possible out of it. Sounds too good to be true, right? Well, it is. Private equity has pushed its business model too far, and now it has trillions of dollars worth of assets that nobody wants. Which sounds like a good thing for regular people who have been the victim of the layoffs and cost-cutting that private equity has become famous for. Right? Wrong. There are 4 reasons why private equity is failing, and 4 reasons why all of us are going to be the ones paying for it. The first reason is that the returns they promised weren't as great as they actually looked. Schrodinger's cat is a thought experiment whereby you put a cat in a box with a poison vial that has a 50% chance to burst and a 50% chance to do nothing. Unless you open the box to see what happened to the cat, there is an equal chance of it being both alive and dead. Physicists use this to describe quantum mechanics, but private equity managers have used it to raise trillions of dollars using one simple trick. My friend Ben Felix, a professional portfolio manager and no-nonsense finance creator, first brought these problems to my attention in a post on Twitter, or X. You should definitely give him a follow if you aren't already subscribed. The value of the private companies and alternative assets that private equity firms built their portfolios around are hard to determine, even by company insiders with full access to their financial information. An unlisted private company doesn't have its stock price instantaneously updated like public companies do, which makes their shares harder to buy, harder to sell, and harder to assign a value to. In the past, investors expected a premium on their returns for compensation for this illiquidity. If you are a rich investor that suddenly needs money to cover an unexpected expense, shares in a public company or listed bonds are much easier to sell than almost any other asset. Liquidating a large number of shares in a private company or selling alternative assets like art, real estate, or patents takes at least a week to find a buyer, draft paperwork, and settle on a deal. And that's the absolute minimum. All of these assets also need someone like a realtor, auction house, or investment banking team to handle the sale, and they are all going to take a cut of the proceeds, which could eat into your returns. For this reason, more liquid assets that are easier and faster to sell at a well-known fair market price are just better. And the only reason why you would invest in less liquid assets is because they could offer higher returns for less risk. Private equity firms have changed this though, by taking advantage of their assets' biggest weakness and using it as a marketing tool. If they never sell the assets they hold and they never release financial statements, nobody has any idea how much their portfolio is worth. So they can just say a higher number every year, and as long as it doesn't get too ridiculous, nobody can call them out. NCAP, a large private equity firm, found itself in a controversy for exactly this, specifically with its investment in Southland Royalty, an oil and gas company. They formed Southland with over a $1.1 billion investment, contributing 80% of the capital, or $880 million, with other investors making up the rest. With their newly formed company, they acquired oil and gas fields around the US, including in the San Juan Basin in New Mexico and the Green River Basin in Wyoming, as well as purchasing 313,000 acres from another oil company. When NCAP set up Southland in 2015, it was hoping for a recovery in oil prices from a drop the year before. In June 2014, it was almost at $100 a barrel, but by the same time in 2015, it hit $55 a barrel. The problem is that oil prices didn't reach those prices again, and their new oil fields didn't produce nearly as much as they wanted. Fast forward to September of 2019, and they still valued Southland close to the same amount as their original investment. But 2 months later, they marked it down to $0 and filed for bankruptcy. When private equity firms represent the fair value of their companies accurately on their books, it's called marking to market. And since they need to compete with other private equity firms to raise money from investors for their next fund, they're not always going to be honest about their underperformers if they don't have to. Private equity managers could reinforce this idea by only selling their highest performing assets, furthering the illusion that everything in the portfolio was doing equally well. The very fact that these assets don't have instantly updated price information actually made them even more attractive with certain fund managers, because it lets them claim to their own investors that their money was growing steadily even during turbulent markets. For a while, this was true. After all, something is worth whatever a buyer will pay for it. But now, the investing public has realized that private equity firms are holding onto a lot of garbage that is going to be very hard to sell. All investment carries risk, and if this were just a story about financial managers delivering bad returns to rich investors after making big promises, it wouldn't need its own video. But a lot of private equity money is your money. And if this convenient lie unravels, it's not going to be the private equity partners losing their jobs. Private equity used to be an elite investing strategy only open to ultra-wealthy, sophisticated investors, and back then, it did deliver returns above the market. Warren Buffett's Berkshire Hathaway can attribute a lot of its early success to operating like a private equity firm with famous investments like the Nebraska Furniture Mart and Heinz being private equity acquisitions. Investors saw the potential of private equity, and now it's gone mainstream. According to data from Morgan Stanley and published by the Financial Times, the assets under management in private equity have grown by 1,400% since the year 2000. Private equity strategies like growth equity have grown even faster. There is now 10,000% more capital in this space than there was just 24 years ago. And that alone is the second reason why the golden age of private equity is over. Charts that look like this in finance are notoriously always very sustainable, safe long-term plays that never end up collapsing aggressively. For legal reasons, that was sarcasm before you load up on Blackstone call options. Obviously, this can't go on forever, and already private equity's biggest threat has become private equity itself. If you are the only person in town buying real estate and there are a lot of renters looking for a place to live, you can pay whatever you want for a house because sellers have nobody to sell to but you. And you can charge whatever you want in rent because renters have nobody to rent from but you. Your returns from this kind of market should be extremely strong. For a long time, this is how private equity made their money. There weren't many firms buying private companies, so anybody that wanted to sell their business had to basically accept what these new firms were willing to pay. As more firms moved into the space and raised more money though, there was more competition to purchase these businesses. If you are a private equity manager and you can buy a business generating an EBITDA of $500,000 a year for $1.5 million using all debt, you will pay down the loan in a little over 3 years and then you can sell the company for the same price, profiting $1.5 million. If you get into a bidding war with another private equity firm though, and the acquisition price becomes $5 million, then you are no longer even beating regular market returns. Now, this simply won't do, because if you can't beat the market, your investors will withdraw their money and you will miss out on your multi-million-dollar bonuses. So, you need a way to keep people invested, which is the third reason why private equity is struggling. Private equity managers get most of their money from delivering investment returns in excess of broad market performance. But data from Cambridge Associates, Capital IQ, and Bloomberg shows that the competition for buying companies has pushed valuations up. And using EBITDA over EV, a measure to determine returns, the average private equity fund underperforms the S&P 500 before fees. This was also shared by Ben, whose literal job it is to pick good investments for his clients. To try and maintain their relevance, private equity managers have resorted to leveraging up their business as much as possible, and cutting expenses wherever they can to increase their earnings. The most popular way to do this is with layoffs. A report by the Private Equity Stakeholder Project found average job losses of 4.4% in the 2 years after an acquisition by a private equity company. That doesn't sound too bad until you remember that most companies add employees over time, and this study was conducted during a period when unemployment as a whole fell by 4.5% nationwide. Cost-cutting has also resulted in businesses offering worse quality service to their customers. This is bad when they buy your favorite fast food franchise and cut the quality of ingredients in your Whopper. But private equity companies have even cut costs in businesses like nursing homes, preschools, hospitals, and prisons. According to studies from the National Bureau of Economic Research, as well as reports from The Atlantic, The New York Times, and Bloomberg, the endless push to lower expenses and maintain margins has been responsible for tens of thousands of premature deaths in some of the country's most vulnerable people. Private equity managers may be willing to do this to maintain their margins and keep their carried interest. But now, the whole industry has become so large that it's attracting the attention of regulators who are cracking down hard on these investors. At the end of last year, the Senate Budget Committee announced a bipartisan investigation into private equity ownership of hospitals, and simultaneously, the White House announced a crackdown on anti-competitive practices in the space. Congress is also pushing for a new bill that would limit tax breaks for corporate investors buying single-family homes. Currently, they can claim interest and depreciation as tax write-offs, which is making family homes one of the most attractive asset classes for investment funds that have grown too large to acquire more private businesses. 20 years ago, private equity was a niche investment strategy that nobody heard of. But its rapid growth and high returns got the attention of big investors who ruined a good thing by taking it too far. Now, it's got the attention of young people who can't afford a home, elderly people who can't afford care, and politicians who can't afford to not look like they are doing something to fix this problem.
BlackRock. I actually believe inflation will be abating very rapidly.
We now have $170 billion of dry powder available to invest.
BlackRock and Blackstone are finance companies that control trillions of dollars worth of assets between them.
BlackRock, State Street, and Vanguard control $22 trillion in assets, which is roughly the equivalent of the entire gross domestic product of the United States of America.
There's a good chance that some of your money is controlled by one of these companies without you even knowing about it.
And what if I also told you that it's very likely you are responsible for the funding of this company and allowing it to do what it does?
BlackRock was one of the largest investors in the ill-fated FTX, and Blackstone has been blamed for single-handedly causing the housing affordability crisis. But how do these companies actually work? And are they really the most evil businesses in the world? Well, no. Sorry to ruin the fun, but if you remove the ominous-sounding background music and carefully selected headlines, these are just regular investment firms like any other. Not bad, not terrible.
And it's also nice to just give money directly to people to change their lives.
But I think the best way for you to realize this is to get a clear breakdown of how these companies operate. Blackstone and BlackRock are both asset management companies based in New York, and they both have Black in their name. But that's really where the similarities end. Blackstone is an alternative investment management company that was founded in 1985 by Stephen A. Schwarzman and his former boss from Lehman Brothers, Peter Peterson. Yes, that's his real name. This is how the company got its name. Schwartz is German for black, and Peter, Petros or Petra in Greek means stone, hence Blackstone. Blackstone raised money from very rich people that wanted to make investments that weren't available to regular folk. The company originally started by underwriting mergers and acquisitions of other companies. Schwarzman was the former head of M&A at Lehman Brothers, so companies trusted his skills to get their deals done. Blackstone's job was to mediate deals between a company that wanted to buy another company. M&A guys will never say this out loud, but it's very similar to what a realtor does, only instead of selling houses for their clients, they are selling companies. The reason that Blackstone needed to raise money was that underwriting M&A deals can be very lucrative. But if something goes wrong, the underwriting company can be responsible for covering damages, and they legally need to prove they have the cash on hand to be able to do that. The early years of Blackstone were very lucrative, as companies were lining up to use their M&A services, but that only made the company a few $1 million in commission for each successful deal, and Schwarzman in particular had much grander ambitions.
Where I'm really confident is when I've thought about something and I've figured out, what a solution is, and then I'm willing to bring that to anyone at any level in society. I've always been like that because I'm just trying to be helpful.
He wanted to raise a private equity fund, which is a fund that invests in companies that are not listed on public markets. Blackstone wanted to get into private equity because the freedom to invest in assets that are not usually available to regular people meant that they could make big returns and charge big fees. The problem was that Schwarzman and Peterson struggled to find investors because people were very happy to invest in their business doing M&A, but neither Schwarzman or Peterson had any direct experience in company buyouts. To initially get around this, Blackstone adopted a merchant banking model, which is just a Wall Street way of saying that they would enter deals with an investor partner. They would provide the M&A services and general business expertise, and the investor partner would provide the capital. This strategy didn't last much longer than a year, but it did allow them to demonstrate to their wealthy investors that they were more than capable at making their own private equity deals, so raising their own money was no longer a problem.
We ended up raising the biggest first-time fund in history with two people who'd never made an investment just by force of will. So it does show you that force of will counts.
By 1988, Blackstone was branching out into lots of different investment vehicles, including a new business venture that would aim to do almost the exact opposite of what their business was doing at the time. BlackRock was formed as a 50-50 partnership between Blackstone and a handful of Wall Street veterans, including Larry Fink, who was a senior executive at Blackstone but moved over to be the CEO of BlackRock. If you are still confused by the names, you should know that Schwartzman and Fink did this intentionally. They were warned not to make the company name sound too similar because it would cause confusion, but they did it anyway because they liked the idea of having a family of investment companies. While Blackstone was focused on working with wealthy investors who wanted access to deals which were not available to the general public, BlackRock was founded with the idea of making investing into public companies as easy as possible for regular people. BlackRock's primary business is index funds. These are pools of assets that BlackRock will blend together and then sell shares of while charging a very small fee for this service. BlackRock offers these shares directly to investors and also sells them on dozens of different securities exchanges all over the world. This can be very convenient for investors who want to have investment exposure to different markets but don't have the resources to purchase foreign assets directly. Together with State Street and Vanguard, BlackRock is one of the big three index fund managers, and is actually the largest of the three thanks mostly to indexes that many of you would be familiar with, such as IVV, which is a weighted index of the S&P 500 and currently has $295 billion in assets under management just by itself.
And the scary part is that if this trend continues, then those fund managers in those three companies will have total control over all the major US corporations.
The benefit of this to normal investors is that they can get a diversified portfolio of investments without having to buy a weighted portfolio of shares all by themselves, which would cost over $2 million at minimum just to have a weighted exposure to a group of shares like the S&P 500. Today, BlackRock controls over $10 trillion in assets under management, and Blackstone, the original private equity company, has $800 billion in assets under management. That might sound like BlackRock has gone on to be much larger and more successful than the company that founded it, but BlackRock only makes a tiny commission on the assets it controls, so even though Blackstone controls less than 10% as many assets, it still makes about the same total revenue and net profit. BlackRock was just another investment to Blackstone, and despite the similar name, Schwartzman's company sold off its shares in BlackRock in the mid-1990s. To date, the companies have little to do with one another apart from their name and shared history.
In fact, when I think about the really bad people, E-Corp, the largest conglomerate in the world, they're so big they're literally everywhere.
So, are these companies evil? Well, all companies have a fiduciary duty to their shareholders, which means that they are legally obligated to make as much money as they can without breaking the law. That means that these companies, like most companies, can often do things that people don't like in the process of maximizing shareholder value. These companies also have a fiduciary duty to the investors that put money directly into the products that they manage. Some people might have shares in BlackRock or Blackstone and have nothing invested into their financial products. Similarly, millions of people invest in the financial products of these companies without actually owning any of their shares. If you are still confused, think of it like a bank and a bank account. It's possible to own shares in a bank without having a bank account with them, and it's also possible to have a bank account at a bank that you don't own shares with. But either way, you would really want to make sure that the bank is doing its best to make sure that your money is well protected. It's possible that a financial product that either of these companies offers has a good year while the company itself has a bad year and vice versa. But obviously the management of both companies want to make sure that all of their investors do well, because to keep their shareholders happy, they need to sell financial products, and to sell financial products, they need those financial products to do well. The biggest controversy with BlackRock is simply the sheer size of its pool of assets. Managing $10 trillion in assets means that the company has significant holdings in most of the largest companies in the world. This means that when it comes to shareholder votes, the management of BlackRock can be instrumental at deciding the direction of a company. This is half true. BlackRock does have major stakes in a lot of very important companies, but they don't own them. They simply purchase them on behalf of their clients, which is anybody who is invested in one of their index funds. The company does still have the power to vote on shareholder decisions, but they try to be as transparent as possible with their votes, and they also have functions that allow index fund investors to vote on which way BlackRock will vote. If a company that BlackRock has 20% stake in is voting on a new CEO, and 55% of the investors in a BlackRock index fund vote for candidate A over candidate B, then BlackRock will vote for candidate A. In truth, most investors in BlackRock funds never bother to vote anyway. I personally find it funny that BlackRock always seems to get so much negative press as an evil empire that is secretly pulling the strings of corporate America, when Vanguard has nearly the same assets under management and operates in almost an identical way. The only logical explanation I can think of is the name BlackRock just sounds more evil to unsophisticated financial content creators.
The second is corporate governance. If you have two large managers owning very significant stakes in many American companies, what does that then mean for corporate governance?
Blackstone, however, might deserve some of the criticism it gets. One of the biggest company's private equity ventures has been residential real estate. Blackstone found that their business could build and scale an investment property portfolio very quickly by taking advantage of shared management costs, top-tier market data, and access to interest rates significantly lower than individual home buyers or investors. Their wealthy clients loved this asset class because it let them put millions or even billions of dollars into residential real estate, but did away with the need for them to find, finance, and manage thousands of properties themselves. The bottom line is that Blackstone can offer their wealthy investors access to the market while charging a lower fee than a typical investor would pay to a property manager. It's a very compelling investment vehicle, and Blackstone has deployed over $280 billion into real estate in total. Typically, Blackstone targets upper-middle-class single-family homes in good areas, and the company itself has noted in investor reports that the average family renting a Blackstone house earns almost double the average national income. The company does also invest into commercial properties like malls, factories, warehouses, and medical centers, which were actually the first pieces of real estate that the company targeted. Schwartzman said that dental offices made great investments because not many people thought to invest in them, and that dentists were great tenants because they had high incomes and didn't want to be kicked out of their office because the cost to refit a new clinic was very high. Blackstone has done well for its investors by buying real estate, but that success has potentially come at a great cost to regular people that just want to buy a house to live in. For individual home purchases, Blackstone has practically infinite capital, and it's often not worth the time of a regional managing director to haggle over the price of a home. This has meant Blackstone often comes into home sales and offers well above asking price to create a quick sale so they can quickly move on to their next purchase. Overpaying for real estate might not sound like a great long-term business strategy, but if Blackstone owns enough homes in an area already, then overpaying for one property can push the value of all their other homes up because realtors and appraisers use those recent sale prices to make price guides for future sales. If BlackRock owns 200 homes in a neighborhood that are all worth $500,000 and then it pays $600,000 for another similar home, then all of those price guides for their existing 200 homes will jump up to that price since it's what the market is paying. That means that they may have overpaid by $100,000, but they just generated $20 million in capital growth for their investors. Artificially increasing the value of their own market means that BlackRock can report fantastic earnings for their investors, even if they would struggle to realize those earnings if they ever had to sell off their property assets. When private equity does this, it's called the mark-to-market fallacy, and it's normally a big red flag when investing in a private company. But for single-family homes, it's easier to say that the house was different to the ones they invested in earlier to justify the price premium. Stretching the truth to investors is one thing, but this whole process has had its part to play in the house price increases that are making it harder for people to simply find a place to live. For perspective, Blackstone only owns 0.2% of all single-family homes in America, and more broadly, all institutional investors collectively own about 0.6% of single-family homes. That's still a lot of homes, but hopefully it shows that what you might have heard about Blackstone buying up all of the property in America and pricing regular people out of the market simply isn't true. Blackstone and BlackRock are just vehicles for all different kinds of investors to put their money to work, and it's these two companies' responsibility to make those investments as profitable as possible. The menacing names of these very large and largely misunderstood institutions are probably where most of the controversy comes from. They are by no means forces for good in the world that their company websites would have you believe, but they are not evil empires after world domination either.